All right, let's dive into one of the absolute giants of Indian finance, HDFC Bank. Now, this isn't just any bank, it's a titan. But right now, it's at a really fascinating crossroads, facing what you might call a trial by the market. So let's unpack what's really going on here.
We're kicking things off with this quote because, wow, it just perfectly captures the puzzle we're looking at. How on earth does a brand that's practically a household name for stability suddenly become the stock nobody seems to want? It's a heck of a mystery.
And that really leads us to the two big questions we're going to tackle. First, what's actually driving the stock's poor performance lately? And second, the million-dollar question for anyone watching, is all this turbulence a huge warning sign, or could it be a golden opportunity in disguise? We're going to look at both sides. To really get a handle on HDFC Bank's current situation, we have to talk about the single biggest event in its recent history. I'm talking about the massive, colossal merger with its own parent company, HDFC Ltd. This wasn't just some small deal. It changed the very DNA of the bank.
I mean, just look at the sheer scale of this transformation. Before, HDFC Bank was, a very successful leading private bank. But after the merger in July 2023, boom, it became a global-scale financial powerhouse. We're talking a loan book of over 22 lakh crore rupees. That number is just immense. It's hard to even wrap your head around.
And the logic behind doing this? It was incredibly powerful. The idea was to create this one-stop shop for everything financial. But get this, a whopping 70% of HDFC's home loan customers didn't even have an HDFC Bank account. And on the flip side, just a tiny 2% of the bank's millions of customers had a home loan from HDFC. The potential to sell more products to existing customers was, and still is, absolutely enormous. But of course, a merger this big is never a walk in the park. Despite that amazing vision, the reality after the merger has been, well, bumpy. The bank sailed right into some pretty strong headwinds, and that's what started to make investors a little nervous. Okay, before we get into the nitty-gritty, we need to understand one super important term: net interest margin, or NIM. Just think of it like this. It's the bank's core profit margin. It's the difference between the money they make on loans and the money they pay you on your savings account. A higher NIM, that means a healthier, more profitable bank. Simple. And here we go. This is really the heart of the problem. You can see it right here on this chart. The bank's NIM started getting squeezed. See, after the merger, the bank had to absorb all of HDFC Ltd's borrowings, which were more expensive than the bank's cheap deposits. This squeezed their profit margin, and for investors, seeing that NIM go down was a major red flag.
And it wasn't just the NIM pressure. There were other hurdles too. Suddenly, the bank had to follow stricter rules on a much bigger balance sheet. This means keeping more cash with the central bank and investing more in government bonds, which ties up money. Plus, they got a 3-year deadline to start lending more to specific sectors like agriculture. To top it all off, management actually decided to slow down loan growth on purpose. It was kind of like a perfect storm of challenges hitting all at once.
But that's only half the story, right? To get the full picture, we have to look at the bank's incredible, deep-rooted strengths. Let's call it their fundamental fortress. This is the stuff that forms their defense against all those headwinds.
And the foundation of that fortress begins right here. A 16.4% growth in deposits year after year. HDFC Bank is an absolute machine when it comes to getting people to save money with them. In fact, management has made it super clear their main focus right now is to grow deposits even faster than they grow loans. That's a really smart move.
Now, it's great to bring money in, but you also have to be smart about lending it out. And that brings us to asset quality, which has always been HDFC Bank's calling card. A gross NPA ratio of just 1.4% is incredibly low. It shows that even with all this change, the quality of their loans is still rock solid.
The final pillar holding up this fortress is its capital buffer. A capital adequacy ratio of almost 20% is way above what the regulators require. What that really means is the bank has a huge safety cushion. It has the financial muscle to handle any unexpected shocks and, more importantly, to fuel its growth when the time is right.
Okay, so we've seen the challenges and we've seen the fortress-like strengths. So how are investors making sense of all this? Let's take a look at who's buying, who's selling, and what the big arguments are for both sides of the trade.
First things first, let's see who owns this company. As you can see, the vast majority is held by big institutions, both foreign and domestic. But here's the really interesting part. Recently, both foreign investors and domestic mutual funds have actually increased their stake in the bank. So even though the general feeling might seem negative, the so-called smart money seems to be placing a long-term bet.
And this brings us right to the great debate. You've got the bulls, the optimists, who see all those merger benefits kicking in. They're looking at a potential price of 2,200 to 2,500 rupees. Then you've got the bears, the pessimists, who are worried about a global slowdown or more regulations. They see the stock potentially falling to 1,500 or even lower. Two completely different stories for the bank's future.
So what does the bank's leadership have to say about all this? Well, they've actually laid out a very clear three-step plan. Step 1, this year, grow slower than the market to get everything in order. Step 2, next year, grow at the same pace as the market. And step 3, the year after that, get back to growing faster than everyone else. This shows it's not a panic, it's a very deliberate strategy.
Which leaves us with this final big question. You have a financial behemoth with unmatched size and some truly undeniable strengths, but it's also facing very real, short-term challenges. The ultimate test will be whether it can navigate through this tough patch to finally deliver on that massive long-term promise. The trial is officially underway, and you can be sure the whole market is watching.